All right, folks, today we're diving deep into a crucial aspect of financial analysis, the statement of cash flows. This is one of the three fundamental financial statements, and understanding it is key to assessing a company's financial health, predicting its future cash flows, and ultimately valuing its debt and equity. Whether you're an investor, analyst, or a future CFA charter holder, mastering this topic is essential. Think of the statement of cash flows as the pulse of a business. It tells you where the company's cash is coming from, where it's going, and most importantly, whether the company can sustain its operations and growth. If the income statement shows you the company's performance and the balance sheet shows you its financial position, the cash flow statement reveals the real liquidity behind those numbers. The first step in analyzing a cash flow statement is understanding the sources and uses of cash. This analysis allows you to assess a company's ability to generate cash and its effectiveness in using that cash to fund operations, invest in growth, and meet its financial obligations. Let's consider a company like Procter & Gamble, P&G. This is a mature company with established products and markets. For P&G, the primary source of cash should be from operating activities, basically from selling consumer goods. Since they've been around for so long, they're not in a heavy growth phase anymore, so if they have no profitable investment opportunities, they return cash to shareholders through dividends or share buybacks. If a mature company like P&G wasn't generating cash from its core operations, that would be a red flag signaling potential trouble. Growth stage companies. Now, think about a company like Tesla in its early days. Tesla was heavily investing in R&D, factories, and infrastructure, which meant that its operating cash flow was often negative. This is normal for a growth stage company. However, eventually Tesla needed to turn those negative operating cash flows into positive ones to become sustainable. Companies that can't shift from negative to positive operating cash flows will need to continuously borrow money or issue new stock, which isn't sustainable in the long run. Consider Uber. For many years, Uber had negative operating cash flows because they were focused on growth and capturing market share. However, investors were keenly watching for the moment when Uber could flip to positive operating cash flows, signaling a more stable business model. Evaluating cash flows also helps you understand how well a company is managing its cash to meet its obligations. Positive trends in operating cash flows can encourage investors and creditors because they indicate that the company can meet its debt obligations and invest in growth. Conversely, if a company has high net income but poor operating cash flows, this could indicate poor earnings quality. This might happen if the company is using aggressive accounting tactics to inflate net income without generating actual cash. All right, let's break down what the analyst's role looks like when evaluating a firm's sources and uses of cash, especially focusing on operating cash flows. As an analyst, you're basically the financial detective, and operating cash flow is one of the most crucial clues. So what exactly are you looking for? First up, you're going to evaluate whether the firm is generating positive operating cash flows. This is a big one. Positive operating cash flows mean the company's core business is bringing in more cash than it's spending, which is exactly what you want to see. It shows that the firm's actual operations, not investments or financing activities, are self-sustaining. Imagine a retail company, let's call it Trend Company. If Trend Co. consistently generates positive cash from selling products and managing its expenses well, this indicates that its business model works. It can pay its bills and reinvest without relying on outside financing. But if cash flow from operations is negative, Even if the firm is profitable on paper, that's a red flag. It could mean that profits aren't translating into real cash, which could signal inefficiencies or aggressive accounting practices. You need to figure out why that's happening. Next, it's not just about the amount of cash flow. You need to dig deeper and understand why the operating cash flow is positive or negative. If it's positive, is it because the company is managing its working capital well? Are they collecting receivables efficiently, or are they stretching out payables to conserve cash? On the flip side, if cash flow is negative, is it because the company has seasonal fluctuations? Maybe they've invested heavily in inventory or expanded their operations. Or could it be a sign of a more fundamental issue, like poor sales or rising costs? Take a construction company that has high accounts receivable but low cash flow from operations. If they're not collecting payments quickly from clients, their operating cash flow could take a hit, even if revenues are strong. As an analyst, you need to flag this and figure out if it's a timing issue or a more serious problem. The next step is evaluating the magnitude of operating cash flow, how much cash the business is generating or losing. It's not enough to just know if it's positive or negative. You also want to understand how significant that cash flow is in relation to the company's size, expenses, and obligations. A small positive operating cash flow might not be enough to cover the firm's capital expenditures or debt repayments. On the other hand, a large negative cash flow could drain the company's reserves or force it to take on debt to cover the shortfall. You've got to assess whether the firm has enough operational strength to sustain itself over the long term. Finally, it's essential to assess how consistent these cash flows are. A company with stable, predictable operating cash flows is generally in better shape than one with wild swings. As an analyst, you want to understand why those fluctuations happen. Is it because of seasonal sales cycles, market conditions, or maybe even changes in management strategy? Consider a fashion retailer that generates strong cash flow during holiday seasons but struggles during off-peak months. If the company has to borrow heavily during those slow periods, that could be a risk to its financial health. You'd want to assess how well they manage these fluctuations and whether they have strategies in place to smooth out the cash flow. In short, as an analyst, your job is to not just look at the cash flow number, but to really dig into what's driving it, whether it's success or failure. You need to understand the reasons behind the cash flow trends, assess how significant those numbers are, and watch for patterns or fluctuations that could indicate risks or opportunities for the business. All right, let's move on to ratios and common size analysis. This is where we start turning raw data into something more meaningful. Ratios and common size analysis help us compare companies more effectively and track their performance over time. So what is common size analysis? It's all about putting companies on a level playing field. For instance, let's say you're comparing Amazon, this massive behemoth, with a much smaller e-commerce startup. Obviously, Amazon's cash flows are going to be much larger in absolute terms. But by expressing each line item as a percentage of total inflows or outflows, you can compare these companies in a meaningful way, despite their size differences. A great example of where this comes in handy is when you're comparing Amazon to a smaller player in the same space. While Amazon's cash flows are enormous, common size analysis lets you see how efficiently each company is using its cash relative to its size. This way, you can make more informed comparisons. When we're breaking down a cash flow statement, there are two main approaches you can take. The first approach is to express each line item of cash inflows or outflows as a percentage of the total cash inflows or outflows. This gives you a clear picture of where the money is coming from and where it's going in relative terms. The second approach is to express each line item as a percentage of net revenue, which helps in understanding how much of the company's revenue is being converted into cash or used in various activities. Now, keep in mind that when we're using the indirect method of cash flow reporting, we don't see the inflows and outflows presented separately. Instead, in common size analysis, we express the net operating cash flow as a percentage of total inflows or outflows, depending on whether the net amount was positive or negative. So why do we use common size analysis? Well, it's incredibly helpful for spotting trends in cash flow over time. For example, if you notice that a higher percentage of cash is consistently coming from financing activities rather than operations, that might raise some red flags. Additionally, this analysis is useful for forecasting future cash flows. By understanding these trends and how different line items relate to total cash or revenue, you can make more accurate predictions about a company's future financial performance. Now, let's talk about free cash flow, specifically free cash flow to the firm, FCFF, and free cash flow to equity, FCFE. These measures are absolutely critical for understanding a company's financial flexibility. Starting with FCFF, this is the cash that's available to all capital providers, both debt and equity holders, after the company has paid all its operating expenses and made necessary investments. Think of it as the pool of money that the company can use to reinvest in its business, pay off debt, or return to shareholders. For example, let's look at Alphabet, Google's parent company. Alphabet generates massive amounts of cash from its operations. After covering all its expenses and investments, the remaining FCFF is what the company can use for acquisitions, R&D, or share buybacks. A high FCFF is a good sign that the company has plenty of financial flexibility to invest in its future and reward its investors. Now, let's move on to FCFE, which focuses specifically on the cash available to equity holders after all the company's obligations have been met, including debt payments. This is the cash that can be distributed to shareholders through dividends or share repurchases. Take Apple, for instance. Apple has a huge cash reserve, and its FCFE is substantial. This means it has plenty of cash to return to shareholders through dividends and stock buybacks, which is one reason why Apple is seen as a safe and reliable investment. So, in summary, FCFF and FCFE are critical measures for assessing a company's financial flexibility and its ability to invest in growth, pay down debt, and return value to shareholders. Finally, let's dive into some specific cash flow ratios that are especially useful when analyzing a company's performance and prospects. First, let's talk about performance ratios. One important ratio is the cash flow to revenue ratio. This tells you how much cash a company generates for every dollar of revenue. For a company like Costco, which is known for its efficiency, you'd expect a high cash flow to revenue ratio. This shows that the company is doing a great job of converting sales into cash. Another important ratio is cash return on assets, or CROA. This ratio measures the cash generated from operating activities relative to the company's assets. For companies that are asset heavy, like airlines or industrial firms, a high CROA is crucial because it shows that the company is effectively using its assets to generate cash. And then there's cash return on equity. This ratio tells us how well a company is generating cash from its equity base. For instance, if you're analyzing a company like Johnson & Johnson, a high cash return on equity is a positive sign that the company is making efficient use of shareholders' funds. Then we've got the cash to income ratio. This ratio tells you how well a company is turning its operating income, or EBIT, into actual cash flow from operations, CFO. In other words, it shows whether those accounting profits are being backed up by real cash in the bank. A high ratio? Great. It means the company is efficient at converting income into cash. A low ratio? That's a warning sign. Profits might look good on paper, but the cash isn't coming in. Next, we've got cash flow per share. This ratio shows you how much cash from operations is generated per share of common stock. It's a great way to see how much operating cash flow is available to common shareholders after preferred dividends are paid out. A higher number means each share is backed by more operating cash flow. Good news for investors. Now let's talk about coverage ratios. These are key for understanding a company's ability to meet its financial obligations. The debt coverage ratio, for example, measures a company's ability to cover its total debt with cash from operations. If a company like Ford has a high debt coverage ratio, it's a sign that they can comfortably meet their debt obligations, which reduces financial risk. Then there's the interest coverage ratio, which shows how easily a company can pay interest on its outstanding debt. For a utility company with high fixed costs, a high interest coverage ratio would indicate strong financial stability. Now on to the reinvestment ratio, which measures how much of the operating cash flow is being reinvested in long-term assets. For companies like Amazon or Google, which are constantly investing in innovation and infrastructure, a high reinvestment ratio is expected. This ratio shows how well the company is using its operating cash flow to reinvest in its long-term assets, things like new equipment, property, or technology. A higher ratio means the company is able to fund its asset purchases from its operational cash flow rather than relying on debt or equity. Next is the debt payment ratio. This ratio measures the company's ability to pay off its long-term debt using cash from operations. A higher ratio suggests the company is generating enough cash to comfortably meet its debt obligations. A lower ratio might raise red flags. Can they keep up with debt repayments? Moving on to the dividend payment ratio. His ratio tells you how well the company can cover its dividend payments using cash from operations. If a company is paying dividends, this ratio shows whether those dividends are being funded by operating cash or if the company is borrowing or using reserves to keep shareholders happy. Finally, we have the investing and financing ratio. This ratio shows the company's ability to fund its investing and financing activities, such as buying assets, paying down debt, or returning capital to shareholders with cash from operations. A higher ratio means the company can cover these outflows with its own operating cash flow, while a lower ratio might mean the company is relying on external financing. Now, let's quickly touch on how changes in the balance sheet accounts affect cash flow. Cash inflows occur when a company receives cash, which can happen in several ways. First, a decrease in an asset brings in cash by selling inventory or collecting receivables, converting those assets into liquid funds. Another source is an increase in liabilities, such as taking on more debt or delaying payments, which allows the company to hold on to cash longer. Lastly, an increase in equity, issuing shares or raising capital, brings in cash through new investments. On the other hand, cash outflows represent cash leaving the company. This happens when there's an increase in an asset, such as buying equipment or expanding inventory, requiring cash. A decrease in liabilities, like paying down debt, also uses cash to reduce obligations. Similarly, a decrease in equity, through actions like buying back shares or paying dividends, leads to cash outflows. In summary, these cash flow ratios are essential tools for assessing a company's financial performance, efficiency, and stability. They give you a clearer picture of how well the company is managing its cash and whether it's in a strong position to meet its obligations and invest in future growth. In wrapping up, remember that the statement of cash flows is one of the most telling financial documents when it comes to understanding a company's real financial health. Whether you're evaluating a mature company like Procter & Gamble or a growing giant like Tesla, knowing how to read and analyze these statements will give you a significant edge. This lecture covered the full scope of analyzing cash flows, from understanding the sources and uses of cash, to using ratios and common size analysis, to assessing free cash flow measures. As you prepare for your CFA Level 1 exam, make sure to practice with the examples from the CFA curriculum and FinQuiz's question bank. Understanding these concepts will not only help you pass the exam, but also set you up for success in your finance career. Remember, it's not just about memorizing the formulas and ratios. It's about understanding the story that the cash flow statement is telling you. And that story can be the difference between identifying a great investment or avoiding a potential disaster.